If you wanted to stop working today and turn your nest egg into a paycheck, how big does that bucket of money need to be where you can confidently draw what you need from that bucket of money for the rest of your life? And once you've identified that, everything above and beyond that is icing on the cake.
Search Party is sponsored by Boulay, Kilpatrick Townsend and Stockton, and Oberly Risk Strategies. The lead sponsor is NCL Partners.
So today we're joined by Nathan Faith. You are a wealth partner at Boulay. Nathan, great to be here with you in person.
Yeah, great to be here with you, David. Thanks for inviting me in.
Nathan, you've been on Search Party before, and you've shared your expert advice about wealth generally and the right way to optimize it. But I really wanted to get into kind of the format by which many ETA searchers gain wealth. When we get specifically into ETA search, while there is a great diversity of entrepreneurs that are doing a great diversity of things, there's sort of a format that we can talk about, which is these tend to be people maybe late 20s, early 30s. Sometimes you get a mid-career person where maybe they're in their 40s. But let's just say that in general, you've got a 30-year-old person with an MBA who's about to go buy a business or who partners with other people to go look for and buy a business. So that's their stage in life. They go out, they look for a business. Hopefully they find one where the CEO or the founder agrees to sell it. There's a high failure rate there. There's no guarantee that they will find the business. But then they get the business, they improve it, and they sell it. And now, for the first time often in their life, they are about to have wealth, in some cases great wealth. And that's when they need to have a conversation with you. You have been part of many of these conversations. So walk us through kind of what that stage is like. What is typically on the minds of people who are about to sort of be in a different tax bracket?
Yeah, so great question. The frame of mind is one of realization. So for searchers, they have been grinding. They haven't looked up in probably 20, 25 years, and suddenly their ship comes in, financially speaking. They beaten the odds. Everyone and everything was telling them they weren't going to experience that exit. And then suddenly they become real emotional people all over again. It's not uncommon to get a phone call and the person on the other side is saying, I'm approaching this exit. My ship is coming in. I don't know what to do. And you can actually hear it in their breathing. They hyperventilate because the numbers that were always too far into the future to really think about, even though that was their goal, now become very raw and very real, but they don't know what it necessarily means. What does that mean for them personally? And what does it mean for their decision that they have to make when they sign those closing papers, as far as what do they take off the table and what do they potentially risk again and roll forward?
What are some very important decisions that a newly wealthy person, especially if they're still in their 30s perhaps, needs to make when they're about to come into some money?
So the biggest decision directionally from a values perspective, from a life perspective, is what comes next for them. When they exit, they lose their job in most cases. They were running this company. They were the head honcho. They were the boss. And they learned a lot. They probably got pretty good at it. But what do they do after? That's a question that most of our clients ask, whether they're 30 or whether they're 65. And if they have some direction on what that means, that helps them decide what to do in that moment. So for instance, if they know that they want to do this again and they want to acquire a company and lead it, and likely a larger company, it's good to know that. But it's also good to know if they say, I only had the energy to do this once. I want to do something different, or I don't want to do anything at all where I have to earn another dollar. And if they have clarity and perspective on those fronts, then we can start to have a more direct and definitive conversation on what they should decide to do in that moment.
In the world of ETA, these are entrepreneurs. They chose a different path, typically out of business school. A more traditional path would have been going to an investment bank, going to a big consulting firm, maybe, McKinsey, going into private equity. But instead, they wanted to go out and buy a second-tier city's biggest HVAC business and run that and hopefully succeed. When they do come into some wealth, if they're fortunate enough to reach that stage, what do they most often decide to do? How often is it that someone from the ETA world says, I'm done, I want to go to the beach, I'm done trying to earn dollars?
I would say more often than not, it's exhausting. You think of other career paths that folks may only have the energy to do something big like that once because they're naive enough to enter it in the first place. An example that I can think of is someone joining the military. They're naive. They're usually a teenager when they sign up. They join and then they realize they wish they would have known what it's like to step off the bus at basic training. I would relate that to being an entrepreneur. It's really, really hard. And just about everyone who's gone through the ETA space, when they mentor and coach upcoming students at, say, a university conference, they're telling those students, don't do this unless you're willing to sacrifice and take the pain. Go in with your eyes open because you typically only have the energy to do it once, maybe twice. It seems like most folks who have successfully exited their first business end up investing and coaching into subsequent businesses for entrepreneurs who are naive enough to do it for the first time themselves.
Let's get back to kind of the mechanics of the exit. The wealth that is created is in the form of shares in a private business. The private business is now going to change hands, and the searcher typically has been awarded a certain percentage of the business, like sometimes 20% or something like that, right? When in that end zone, what are some smart strategies that the searcher needs to consider to make sure that they're doing it the right way during this kind of very important period?
Great question. Really, the decision for what to do with the funds breaks down, in my opinion, into three buckets. The first being if you are exiting with some level of money. I'm just going to pick a number and say $1 million. What happens to that $1 million if you were to cash out and walk away right now? The top line number is almost never the same as the bottom line number. It's important to identify who your partners are, and the biggest one being your partnership with Uncle Sam. And so from a high level, if your gain is all treated as a capital gain, the federal government is going to charge away about a fifth of what you take in. So on $1 million, it's $200,000 of taxes that are due in April of the year after you sell. And then depending on where you're located, the state may take a slice as well. And that slice can be as high as, say, half of that federal slice. So I live in Minnesota. Minnesota would take another $100,000 off of that $1 million check, and I'm left with $700,000 to decide what to do with thereafter. And that brings us to our next two buckets, and I call those buckets the end zone bucket and the legacy bucket. The end zone bucket is if you wanted to stop working today and turn your nest egg into a paycheck, how big does that bucket of money need to be where you can confidently draw what you need from that bucket of money for the rest of your life? And once you've identified that, everything above and beyond that is icing on the cake. And that directionally can be called your legacy bucket. What do you want your financial story to look like for your current or future children, your current and future grandchildren? Do you want that to perpetuate for theoretically ever? That's a different number, but the end zone number identifies what the legacy bucket can be.
That is a capital that is meant to be reinvested. And that can be in perhaps the company that is acquiring their company. They roll their equity into that opportunity. Maybe they're setting it aside because they want to be backers of other searchers and they want to have a defined pool of capital to back those searchers, right?
The legacy money, you can take on different kinds of risk than you can with your end zone money. With legacy money, you can be concentrated. You can roll equity into that one company or a handful of companies and be comfortable and okay with that. But with your end zone money, you want to be more diversified typically. You want to be more liquid because you're going to be accessing the funds near term versus a decade from now.
Talk about something called Flex SMA.
So Flex SMA stands for Flexible Separately Managed Account. What it is, for all intents and purposes, is a brokerage account that has hundreds of individual positions in it. What's the power behind it? Imagine your ETA searcher exits their business on January 1st of next year for $1 million. And they take all the money off the table. They have $1 million in their bank account, and yet they may owe, say, $300,000 in taxes the following April when they have to report this $1 million profit on their sale. A strategy that can help minimize that near-term expense and defer and push it out into many, many years going forward is to use capital losses to offset the capital gain in the calendar year that you're reporting it. And so there's a recent innovation in the financial planning space called these flexible, separately managed accounts that use some creative ingenuity to take meaningful money and create meaningful losses to offset that gain. So functionally, how does it work? Normally with a portfolio, if we were to invest $1 million throughout the year, some positions would go up, some positions would go down. And if we wanted to cherry pick the ones that went down, we could maybe harvest about 10% of that portfolio in the form of losses. You can use your brokerage account like you use your home to essentially get a mortgage on your brokerage account. The loan is called a margin loan. And what the strategy does is it creates extensions. And you can, say, increase your exposure to the market on either side by, say, 1 or 2-fold. If the market goes up, you have positions that are going down at that time, and you sell those losses. And then if the market goes down, the other side of the portfolio will generate losses. So regardless of what's going on in the markets, whether they're up or down, the strategy can allow you to harvest losses throughout the year in a big way. The strategies typically can allow you to recognize 30, 50, and in some cases 100% of the losses in the account versus the value of the account. So we have clients who, if they sell early in the year, deposit funds, we can create losses that equal the gain that they'd otherwise recognize in that portfolio. And what that means is, at the end of the day, the one company that they sold for $1 million becomes hundreds of companies invested in a brokerage account, individual stocks, that they now have the $1 million gain diversified amongst hundreds of positions. And thereafter, they can sell individual positions and pay small taxes as they need cash flow. And that strategy is exponentially valuable for those who are young and those who go from high tax brackets to lower tax brackets.
Well, that certainly sounds like a new and innovative approach and a tool that an entrepreneur could use to optimize the gains that they've had from their successful round trip as an ETA. Are there any other structures or strategies out there that are worth talking about?
Yes, there's one particular that can be a game changer with this conversation. It is relatively rare and somewhat unique, and it's one called a qualified small business stock strategy. The technical term for it is the 1202 gain exclusion. And where that applies is for someone exiting a C corporation, one of which they've invested and held the stock in that C corporation for at least 5 years under the most recent examples. And they have to check a few other boxes, such as it's essentially a startup. It had a certain level of assets. It's in the right industries. But if that's the case and they check those boxes, say they bought into this company in 2021 and they sell at the end of this year, they may be able to avoid taxes on the first $10 million of profit on that stock. So instead of paying, say, $3 million in taxes on a $10 million exit, they pay nothing at all. The Big Beautiful Bill law that was passed last summer enhanced that strategy going forward, where for those who buy into new C corporations that qualify, after 3 years, they get half of the exclusion on the first $15 million of profit. And after 5 years, they qualify for up to $15 million of tax-free profits on an exit from qualifying businesses. It can be a game changer.
And the government has instituted this to incentivize investment in smaller businesses. Is it specifically to startup type businesses? Give us just an overview of the kinds of businesses that Uncle Sam wants to see more of and therefore has created this program to encourage.
Startups are the most common. So you think of the tech companies in California, they oftentimes qualify for this strategy, but it doesn't necessarily have to be a startup. It can be an existing business that's just small enough. And what the government defines as small enough under the older system was have less than $50 million of assets, which can be a pretty big business. And at least 80% of those assets are actually working within the business. So it excludes certain things like financial advisors can't sell their practice and qualify for this strategy, but technology companies can. And so if folks check the right boxes, they may qualify for this strategy. And what's surprising is, believe it or not, most tax accountants aren't aware this strategy exists. And if they are, they don't always do the homework to make sure that you do or don't qualify. And so always ask the question. It doesn't hurt. And I've seen good accountants save millions of dollars for their tax clients just because they were aware of this strategy that the ETA exeter qualified for but didn't even know existed.
Is awareness of this strategy required going into the business? Should you understand whether or not it qualifies before you buy the business, or is it okay to make that designation while you're exiting?
So ideally, you can be proactive and identify if a business you're acquiring would qualify for this future tax benefit, or you could structure your, let's say, interest in the business to qualify for this exit. It's a cost-benefit calculation. But if you've already acquired the business, you either qualify or you don't. And there's no cost to identifying if you do or not. It helps you make decisions going forward. So both proactively and reactively. If you do qualify and haven't yet exited, there are significant proactive planning strategies where you can exponentially enhance that strategy for those who have a really successful outcome in the works.
Maybe let's just do a quick anecdote. Let's say someone buys a qualified business in this sense for $1 million, and 6 years later they sell it for $100 million.
In that example, under the new law, if they held the stock long enough, the first $15 million of profit would be tax-free to them, and then the remaining, call it $85 million of gains, would be taxable at roughly a fifth federally, so call it $16 million in federal taxes, and if it's in a taxable state, maybe another $8 million in state taxes. But that's where having proactive planning conversations can be very powerful. a little known strategy, if I were to pick a number, less than 1% of financial planners and accountants are aware of this strategy, is one called the stack and pack strategy.
Stack and pack.
Stack and pack. How it operates is the qualified small business stock exclusion applies to each taxpayer. So husband and wife file one tax return, they qualify for a $15 million exclusion. But if you identify our end zone money is that first $15 million, the rest is legacy money, you can create trusts, which are their own taxpayers for your children, and stack on additional $15 million exclusions for each of them. So for example, $100 million exit, you would need, say, 7 taxpayers. Yourself is $15 million, and then let's say hypothetically you have 6 children. You'd open 6 trusts and deposit 1/6 of your shares into each of those trusts, and when the exit happens, collectively you have $100 million of proceeds, but you also have $100 million of collective exclusions, and you've essentially turned your business exit into a tax-free event. That's a scenario where a little awareness, a little proactivity can go a long ways.
I guess the message here to young searchers is that they should start having children and as many as possible in order to optimize their taxes, and because it's fun, right?
Well, yes, that too. And to really be selective which businesses you invest in and how you can exponentially magnify their value. So probably focus on magnifying the value of the business first, and as you gain optics into how it's growing, then you can do some family planning.
Start banging out the baby.
Yeah.
Right. Got it. Nathan Faith, wealth partner at Boulay, thank you so much for sharing your wisdom with us. And I know that we're going to have you back on Search Party because this is a big, important topic. And it seems to be changing on a regular basis as new regulations come in and perhaps new innovations in wealth planning come in. We'd love to hear all about them from you.
Okay, sounds great. Well, thanks for having me, David, and I look forward to our next episode.
Let's shake hands because we're not doing this virtually. We're actually in the same room,
Right.
which is miraculous.
Search Party is sponsored by Boulay, Kilpatrick, Townsend and Stockton, and Oberly Risk Strategies. The lead sponsor is NCL Partners.